Welcome again, business management students. We are continuing with the chapter financial management. So this is part 2 of 4. So I'm just picking from where we left in the previous session. We were discussing the objective of financial management, and on this one, it is important for us to realize that the long term should be to increase the value of the business. To increase the value of the business, how do you increase the value of the business? This can be increased through investing in opportunities that will yield higher returns, and also utilizing funds that have a lower cost of capital, because those two will lead to profitability in the organization, and profitability will also lead to sustainability in the business. So this can be the long-term objective of the business, which is to increase the value of the business, can be accomplished by investing in assets that will add value to the business, and also by keeping the cost of capital as low as possible, which is basically what I had alluded to. Then the short-term objective, or the short-term financial objective, should be to ensure profitability, liquidity, and solvency of the business. So in terms of liquidity, I remember we had discussed about it, that that's the ease with which an asset can be turned into cash, and the availability of cash or financial resources to meet the daily needs in the operations of the business. But when it comes to solvency, we are looking at the ability of the business to meet its long-term debts, or to pay its long-term debts. So how is an organization, or is an organization able to pay its long-term debts? Maybe using the assets that they have. So if the assets are less than the value of debts, if the value of assets is less than the value of debts, the company may actually be considered insolvent. Or a company can be considered insolvent when it cannot pay its long-term debts using its own assets. So the short-term financial objective should be to meet profitability, to ensure that the expenses are less than the income, also to ensure that the short-term obligations can be met, which is liquidity, and also to ensure that long-term debt can be serviced in the business. Then there are also fundamental principles of financial management which we ought to discuss. These include the risk-return principle, the cost-benefit principle, and the time value of money. So I will start with the risk-return principle. Before, as an organization, you invest in any opportunity, you ought to assess the risk involved and also the returns that are involved. In terms of returns, we are looking at what is it that you tend to benefit after you invest. So you assess the risks and the returns. If the risks are outweighed by the returns, then that particular opportunity will be worth investing in, because the company can benefit, or the business can benefit, and you can actually increase the value of the business. But there are also instances that you realize that the risk can actually outweigh the returns. In that case, there is that opportunity will not be worthy investing in. So there won't be any need to invest in that particular opportunity, because it will actually reduce the value of the business. Another concept or another principle revolves around the cost-benefit analysis, which we refer to as the cost-benefit principle. And more or less the same with the risk return principle. In this case, you assess the costs and the benefits. So before you make any decision, before you make any investment decision, you assess the costs that are involved, including the cost of capital, and you also assess the benefits that are involved, which may also be in terms of the returns, because returns may also be benefits. So if costs outweigh the benefits, it means that opportunity is not worth it, and you don't need to make a decision if it is to invest. You don't need to take that particular opportunity. But where benefits outweigh the costs, then it is worth going for, because the organization will benefit. Then the other principle is the time value of money. The time value of money. I'm sure the time value of money, there is a slide where we are going to speak about it. But basically, or in short, we are saying a rand that you receive today is worth more than a rand that you will invest in future. That is, if we take into consideration the possibility that you can invest that money and earn profit and earn interest over time. So instead of you having your money kept elsewhere, generating returns for someone else, we are saying it's better for you to have it now, so that you can invest it on your own and earn an interest with that money. Because if you have the money, it tends to increase with time. If you invest it, you earn interest. However, it also tends to lose value with time. So if you do not invest it, it will also be affected by inflation. So that concept of time value of money is very important for financial managers and for financial management students. On this particular slide, we are looking at cost, volume, profit relationships. And we ought to discuss issues of relating to profitability, which is determined by the unit selling price of a product, the cost of the product, and the level of activity in the business. So profitability, basically we're looking at the selling price per unit. Then we're also looking at the number of units that are produced in the organization. That will give you the sales. If you multiply the selling price plus the units that have been sold, it will give you the sales or the income. Then you also ought to deduct what are the costs. That will then give you a profit. Change in one of the three components will result in change in the total profit end. So if costs change, or if the amount of units that are produced change, that will actually affect the profit that will be earned. Also, each of those components have to be viewed in conjunction with one another. That is to say, the selling price, the cost of the product, and also the level of activity within the organization. Those three ought to be viewed in conjunction with one another. Then there is another concept which is known as the break-even point. A break-even point is where costs are equal to the total income. So this is where an organization is neither making a profit nor a loss. And this point is important for every business, so that you will understand when can you expect to start making profits. So for entrepreneurs, the break-even point is very important, so that you will understand how many units should you actually produce and sell before you can start making a profit, or so that you will not make a loss. That is the break-even point. The break-even point in a specific case can also be calculated using that particular formula that is given which is fixed costs. Okay, the number of units that you ought to produce is equal to fixed costs over selling price minus variable costs. Selling price minus variable costs is also referred to as the marginal income or as variable profit. So in this formula, N is the in the formula is the number of units or is the volume, where neither profit nor loss is meant. Then the term SP minus V is referred to as the marginal income or variable profit. So it's selling price minus variable cost per unit. That will then give you what is known as the variable profit. Just a graphical representation of the break-even point here, where you are not making neither profits nor losses. So that will be your break-even point. Break-even quantity would then be here at Y, and break-even in terms of amount will be here at X. But the break-even point is the point where, as an organization, you are not making neither profits, you are making neither profits nor losses. So you will not be making any profits, you will also not be making any losses. But any point above the break-even point, you will then start to make profits. And any point below the break-even point, you will be making losses. Okay, now we move on to the time value of money, which we said this considers the combined effect of both interests and time. And the time value of money can be approached from two perspectives, where you can calculate the future value of some given present value. So the future value of a certain amount over time, you can actually calculate, let's say if you invest the amount that you have in 5 years, what may be the value of that money? That can be calculated. You can also calculate the present value of some expected future amount, to say if you want to have $1 million in the next 5 years, how much should you invest at this particular interest rate? So those are the two perspectives to the time value of money. Basically, we are looking at the issue of time and also the issue of what? Of profits. So if you are looking at the first perspective, where we are trying to calculate the first perspective, we are calculating the future value of a given present value. So in this case, we are saying the future value, we want to see the future value of the amount that we have. So we must understand the concept of compounding, that if you invest it, you start to earn interest, and once that interest has been put in on your principal amount of investment, the next period they will be charging, the next period they will be paying your interest. They will actually be paying your interest on the amount that you invested plus the interest that you had earned in the previous periods. So that will be the compounding effect. But if it's if you are calculating the present value of future cash flows or of future amount that you expect to have in future, let's say we say you want $1 million in the next 5 years, then if you want to calculate how much you should invest now, that's where we look at the discounting to present value, because we must also understand that there will be an effect in terms of compounding. So when we want to calculate the present value or how much you should actually invest now, we must also consider the issue of discounting to present value. So to calculate the future of a single amount, how much it will be if you invest a certain amount today. So in that case, you will need to calculate the future value. So the future value of an initial investment or principal is determined by means of compounding. Amount of interest earned in each successive period is added to the amount of the investment at the end of the preceding period. So interest is earned on capital and also on interest in each successive period, as I had explained. So the formula to calculate future values of an original investment is given below, that which we can see, where future value is equal to this future value is this one, the future value of investment after a number of periods, or so n is the number of periods, is equal to present value of the original investment or present value of the investment. Then you multiply it by 1 plus the interest rate. This I represents the interest rate per period expressed as a decimal number. And this n is the number of discrete periods over which the investment is made or extends. So this formula can actually be used to calculate the future value of a present investment amount. Then the present value of a single amount, to calculate it, here the present value of a future amount is the monetary amount which can be invested today at a given interest rate per period in order to grow the same future amount after a number of periods specified by n in the formula. I represents the interest rate, so this is the interest rate, and n represents the number of periods. So in this case, we discount. We use that discounting effect. So we discount to present values. So discounting process is the reciprocal of the compounding process, because you must also understand that for us to reach that future value, there had been an effect of compounding. So we must now discount so that we can go back to the present values. The formula for calculating the present value of a future single amount is this one, which is given here, where you actually calculate the present value being equal to future value. You must also take note of the number of years represented by n. Then you multiply it by 1 over 1 plus interest rate to the power of the number of years. So that is it about what we are supposed to cover in this session. So if you have questions, I encourage you to go on Blackboard, on discussion forums for financial management. Ask your question there so that we will respond to it. Thank you so much. In the next session, we will be proceeding to financial analysis, where we will also look at ratios and so forth. So for now, thank you so much. Study this chapter and participate in Blackboard discussion forums. Thank you.